1980s, IBM wanted to borrow in Swiss francs due to favorable interest rates, while a Swiss company wanted exposure to USD debt. However, neither had the market access or cost efficiency to do it directly. The two companies used a currency swap. IBM issued USD debt and swapped the interest and principal payments with the Swiss company, who did the opposite. This allowed both firms to benefit from better rates in their local markets while achieving their intended currency exposure. This case is often cited as a textbook example of how swaps create mutual financial advantages. A swap is a financial derivative in which two parties agree to exchange streams of cash flows over a specified period. Swaps are typically traded over the counter, OTC, and used for hedging or altering exposure to financial variables such as interest rates or currencies. An interest rate swap involves exchanging fixed rate interest payments for floating rate payments, or vice versa. Example, Company A has a floating rate loan but prefers fixed payments. Company B has a fixed rate loan but wants to benefit from falling rates. They agree to swap interest payments, allowing both to manage risk according to their outlooks. The most common type is called plain vanilla, which involves fixed versus LIBOR or SOFR-based floating rate. A currency swap involves exchanging both interest payments and principal in one currency for those in another. These swaps are used when a firm needs to fund operations in a foreign currency or when a company wants to hedge currency risk on foreign assets or liabilities. Unlike interest rate swaps, currency swaps involve an initial and final exchange of principal amounts. Risk management allows protection against interest rate or currency fluctuations. Access to cheaper financing lets firms borrow in domestic markets and swap to desired exposure. Customization means terms can be tailored to specific needs such as notional amount, duration, and frequency. The lack of exchange trading due to the OTC nature offers flexibility but also introduces counterparty risk. Valuation of swaps is done as the difference in present value of future cash flows between the two legs. Mark-to-market practices apply, as their value can fluctuate and may require collateral. Credit risk is managed through collateral agreements and clearing mechanisms such as central counterparties. Regulatory impact from post-2008 reforms has pushed many standardized swaps toward clearinghouses. Corporates use swaps to lock in financing costs or convert loan currencies. Banks employ swaps to hedge mismatches in asset liability profiles. Hedge funds use them to speculate on rate differentials or macro themes. Governments and agencies utilize swaps to manage sovereign debt exposure or currency reserves.